Read chapter 5. Bare skrive det.
Ja, men det er måten han bare skriver det helt casual, bare read chapter 5.
Last week we did finish chapter 3, income statement, and now basically one main chapter is left and one main financial statement called the cash flow statement. But before we get to the cash flow statement, I will do two more things with you. First thing is we talk a little bit about the self-assessment question in chapter 4. Chapter 4 is on limited liability companies. This will not be specifically a part of the exam, however, I anyhow recommend you reading this chapter to get a better idea of what all this accounting is about. Plus, there are a few things in chapter 4 that will pop up in chapter 5, and chapter 5 is something we will do. And about these small things I will talk today. We'll do this very quickly, but then you at least remember, there was something when we jump into chapter 5 with the cash flow statements. And when we have done this, we will do a little bit on double entry bookkeeping. I mean, I mentioned last week that those of you who had some financial accounting introduction course already probably did some double entry bookkeeping with T accounts. I'll give you a quick heads up on how this works in general, and maybe related to the exam, of course, you're allowed to handle transaction with T accounts if you want. But I do not expect this of everybody, so it's just another tool. You can use it, but you do not have to use it. But I think not all of the 3 study programs relevant to this course here will have further accounting classes, but I think at least the BBA students who will have another financial accounting class, and there this debit, credit, T account things will come once more, so you have a little bit of a head start if you consider this. Okay, and as I said, when we're done with this, we look at the cash flow statement, and my hope is that we are done by the end of next week with all of them, and then we're basically finished with the first big bunch of this whole course, financial accounting, and then we will switch to managerial accounting starting chapter 7, I think. Yeah? So we will skip this ratio chapter 6. Okay. As I said, we will have a quick look at the self-assessment question, and in the end, what you see here, it's again like the exercises for chapter 3. You have an income statement, you have a balance sheet statement of financial position, and then there are a bunch of transactions that should be considered to set up these financial statements, right? So same setting basically, but there are a few elements in that slightly differ, and that's what I want to present to you today. So if you look at this slide, at this Excel file, here I basically marked what's different. So what we have here is basically this big yellow part. So until now, we only had this one item equity on the balance sheet, and now things look a little bit more different. Yeah? You might remember, I think it was you who asked why do we directly put everything in equity, and I told you, well, it's a simplification, but here you are with the retained earnings, right? So you see the equity is kind of split in different parts. First part is share capital. That's basically the money that came into the firm when the firm was founded. So in all our exercises we had, well, someone founds a firm and injects 50,000 into a bank account. That's basically that. So when the firm is founded, shares are issued. You might know this term, initial public offering, when a firm becomes public. So it's the money related to the first bunch of shares given out to the people. And this stays forever as it is. Yeah? But this does, of course, not reflect the whole equity. If the firm starts to work and does business, yeah, then comes something on top. What we have here on top is this share premium account. That's something. It can be a different. If there is then a second round of share issues, not the first round, then you get something like this. Yeah? And then what is, I would say, important to go further on is here the retained earnings. So until now, we added everything directly to equity. That's not how this is done for limited liability companies. There you have really the share capital and then retained earnings. So you see what came on top to this money that was there initially. Yeah? And this last line here, profit for the period, that's actually something that does not come up in financial statements. That's part of the exercise here because, well, there are some mistakes. You have to correct for these mistakes. It's just to see what part of the retained earnings is the profit of the period and what's, well, the retained earnings from previous period. So that should not show up on such a balance sheet. Yeah? And then, if you look at the exercise, I think you should all be able to do this. So there are a bunch of transactions, but that's nothing that is out of the ordinary. We did that before, and you see in the end what comes up here is, that you have this differentiation here with the share capital, share premium, where everything stays the same because these are things that are not affected by common transactions, right? And then the retained earnings, you see it here, it's out with this profit of the period. It's just part of the retained earnings. And then, second information here, the book makes one assumption about taxes. So if there are taxes, they assume that half of the taxes are paid within the period, yeah? And half of the taxes will be paid in the following period. That's why tax payments are in these exercises here related to this chapter usually split into two parts. Let me see. Yeah, here we are. So you see the tax payment, 30% from the profit before tax is subtracted, and we have the same amount here as a liability. So that's some assumption that is, I would say, kind of hidden in the book. It's just stated somewhere in the middle of the text, so it's not really prominent. But if you read very carefully, you find this assumption, and you're always saying that they deal with this like this. But you see, the tax payment for the year is, as I said, kind of split. Something is paid immediately, so this ends up in the income statement here, and some taxes are not paid yet, so they are considered as a liability, and you see it's a current liability because of course you have settled them relatively quickly. Yeah, that's the second point. Yeah, and I think that's basically the main points. One more thing here I see. Dividends approved, so there was a transaction that the firm wanted to pay or decided to pay out dividends. What are dividend payments? I mean, it's basically giving part of the equity that is in the firm back to the owners. Until now, we had a few transaction withdrawals from the company, right? And this is basically a form of a withdrawal of equity from the company. And here it's a liability because it was decided, but the dividends were not paid out yet. Yeah? But in the end, this is something similar to this withdrawals. Yeah? And maybe with this share capital and the retained earnings. So usually financial statements demand that firms can only pay out dividends from the retained earnings, but not from the share capital. And the reason is basically to protect banks that gave loans to this firm, because they look at the share capital, but they look really how much money will there be in the firm, the owners cannot easily withdraw, take out of the firm. Yeah? So this dividend usually can only be paid out of this retained earnings. That means if a firm was founded, has a certain share capital, but not earned any money yet, they cannot pay dividends. Yeah? So that's basically the point. Okay, so I acknowledge that this was rather quick, but I wanted just to mention the most important points and maybe pitfalls for the next chapter. But are there questions about these points I was just referring to? Yeah, as I said, recommendation is to actually read the book and then think a little bit about these points. Okay. Then, as I said, we go on with double entry bookkeeping. So, I think I told you in the very beginning of this whole class that I'm quite happy with the textbook I found here, because it kind of gives a very intuitive approach to financial accounting. What's going on there, what's the reason. But most textbooks in accounting basically, jump right into this double entry bookkeeping thing, because it's the way transactions are handled in practice. And here the learning outcomes basically that you get an idea of this basic principles of how this double entry bookkeeping works, and that you are able to kind of do everything we did so far, also applying this technique. So as an exercise, if you want to get familiar with how this works, you can really use every exercise we did so far and apply this double entry bookkeeping technique. Yeah? Okay. So that's just the background. And this is actually a slide from the very beginning. We talked about this dual aspect convention, that every transaction basically affects two sides. And this double entry bookkeeping, I mean, the name says it itself, kind of deals with this. So the difference between this convention that every transaction affects these two sides and double entry bookkeeping is basically that this idea of this dual aspect convention is the basis why this double entry bookkeeping was invented in the first place. So double entry bookkeeping is nothing else as a method or system of recording transactions. And yeah, that's basically it. Okay, let me give you a little bit of a background where this comes from, this double entry bookkeeping. So it's ages when this was invented. So you see, it was published in 1494. So you're learning here a technique that is over 600 years old. Yeah? So it might seem a little outdated, and it might also seem a little bit of an abstract thing, because when you look where this was published and who did this. But by the way, those who dealt with this, did you talk about this guy already? Or did you just do the techniques? Who had some experience with double entry bookkeeping? There are a few. There was a hand. Did you talk about when this was invented and when it was set up? No. So this guy was basically a monk, and in these days they were the only educated people, so he wrote a math book. So this was actually in a math book, this idea of double entry bookkeeping. So the question is, why do we still care about something a guy from over 600 years invented, And on top, it was not really about economics. It was basically about math. Yeah? So, what the heck? Why do we still do this? Do you have an idea what's the reason why it's not so bad to still apply this if you really think about this dual aspect convention? What? So can you repeat? To spot errors? Yeah, so it's a system that prevents from doing errors. Can you explain why? Yeah, in the end, everything needs to cancel out, right? Needs to balance, and as soon as something does not balance, you realize that something went wrong. Yeah, that's true. So that's a technical aspect, but in fact, when this was invented, economies basically changed a lot. And I recently read this article by Ray Ball. So Ray Ball is really a famous scholar in our field. So he's a researcher, yeah. So not mainly a teacher, and he wrote this very short article why they came up with this double entry bookkeeping. And in short, the idea is that kind of the economy changed around that time. So this was the time when in Italy trade started to get really, really big. Yeah? And before that, I mean, there was some landlord owning some land, and they demanded the peasants living on their land just to give something to them. So there was not really trade. This was just one directional. But at that time, it started that there is trade. And the basic idea behind this dual aspect convention, this whole double entry bookkeeping, is basically that if you get something, something is at the same time given up. Yeah? So you get something, you give something up. And that's basically this idea of this whole duality thing. And as I said, economy started to work like that in these days, and that's why this monk came to this idea we should do it this or that way. And basically markets still work like that until today, and that's why we still teach this, admittedly very, very old stuff, but the main elements that made this idea emerge are still present in today's markets. So it's not really outdated. Okay, but now let's dig in how this works. So the basic idea is that you set up different accounts. Yeah? So you see where the name accounting comes from. It comes from these accounts. Yeah? So an account is a record of one or more transactions relating to a particular item. Such items are, for example, cash, property, borrowings, revenue, rent payable, equity. So you see, it's basically all elements that show up either in the statement of financial position or in the income statement, right? So these accounts are basically our financial statement elements. And then these accounts are set up in this T-shaped form. In a minute you will see how this looks like. And then these accounts usually have a title. There is this item, cash account, property account, borrowing account, and so on. And as it's a T-shape, they have two sides, and the left side is called the debit side, and the right side is called the credit side. So in the end, this looks like this. So I just did this with Excel, but of course you can also write it down by hand. So this monk guy, but he did not have Excel, he was writing this by hand, but that's basically the idea. And then we have to differentiate between accounts that deal with assets and accounts that deal with claims. So you see, it's kind of the same split as we have in the balance sheet. On the top we have the assets, below we have the claims. Yeah? And then if these accounts increase, for the asset accounts, increases are shown on the debit side. That means, let's for example consider the cash account. If cash comes into the business, then you make a note on the left side. If cash leaves the business, you make the note on the right side. Yeah? So that's basically the idea. For the account of claims, it's directly the other way around, and in a few minutes you will realize why this makes perfect sense. Okay, so let's look at a few examples to get your intuition how this works. So you see here this first transaction we want to put into this account. The owner puts 50,000 into a newly opened business bank account. So it's basically the transaction a lot of exercises so far started with, right? And this is how this is written in this T account. So what happens? 5,000 goes into the business. That means cash goes up. We make this note on the left side, on the debit side. Yeah? And you see how this is written down. It's specified when this happens and what other side of the transaction is affected. Yeah? And so you write this January 1st, equity, cash goes up by 5,000 on the debit side, and equity goes up. So here you see it makes sense that we have increases of claims on the right side, on the credit side. January 1st, it's related to cash, equity goes up by 5,000. So you see, every transaction can be mapped as an entrance on the left side of one account and on the right side of another account. That's basically the idea of this technique. Clear to everyone? Okay. So it's just a convention how to deal with these transactions. Then, second transaction, also something you have seen before and you should be able to deal with. Inventory is bought. So, inventory is bought, it says, it's bought with cash. So, you know, this is basically just an asset swap. Cash goes down, inventories go up. But how do we write this down in these T accounts? Well, cash account is an asset account. A decrease is written down on the credit side. So you see this note, inventories 600 on the credit side, where inventories go up by 600. So this matches, both sides are affected, everything's fine. Yeah? One note on the left and one on the right. Then, next transaction here, 900 cash is paid to rent business premises for the month, for 3 months, sorry. So, yeah, what happens? Cash goes down, that's relatively clear, but rent, yeah, that's something where we need to open a new account. We didn't have this before, and there we make this note cash 900 on the debit side. Yeah, so everybody, everything is in line. I mean, if you read this carefully, what should you think about? If you look at this transaction, why do you need to be a little careful here? When we want to set up financial statements for 1 month, we would need to adjust the rent if we only do it for 1 month. However, well, cash goes down by 900, so we need this 900, but we need to keep in mind that we later on need to adjust something. But we will do this in the very end, just so you be careful. Yeah? Okay, so you see, these accounts do not necessarily only need to be related to the statement of financial position, but there can also be accounts related to the income statement. Yeah? Yeah, and I mean, it's kind of obvious, as before we had transactions that only affected the balance sheet, but also transactions that affected both the balance sheet and income statement, right? So that's the basic idea what's going on. Then, next example here, the business sells inventories costing 200 for 300 on credit. So you see now there are 4 things going on. So it's 2 times 2 things that happen here. Yeah? So one thing is basically the revenue side and one thing is the cost side, and they are different. Yeah? So first thing, let's maybe start with the cost of sales. So inventories are sold, that means inventories go down. So we have this cost of sales 200 on the credit side of inventories, and the counter side of this transaction is basically the cost of sales, yeah? Inventories, 200. And then we have the revenues, and you see these new accounts on the top right. So trade receivables, no, let's start with sales revenue. We have revenue 300, and well, we have sales revenue 300, yeah? We put this on the credit side, and trade receivables go up by 300, yeah? So this asset increases. Okay, and this is basically how this is done, and then there are a lot of other transactions we will quickly go over, and I'm asking you how to handle these. Put them here so you can see the Excel file. Just open this. Okay, so here, if I haven't forgotten anything, everything that was on the slide so far I already have in here. And then we got the next transaction on January 8th, business buys inventories on credit. How does this work? Which accounts are affected? Buys inventories. Cash. Read. Trade payable. So inventories and trade payable. And what's credit? What's debit? So they buy inventory, so inventories should go up. On which side of the inventory account do I have it could be 800? Debit side, right. So here's the inventory account. This is January 8th, and it's trade payable, right? Because it's on credit. If it were cash, then I would write cash, but it's trade payable. The amount was 800, right? So we need to find the counter account. Where is trade payable? We haven't had that before, so we need to open this new account. Yeah, and here we then basically have this transaction from January 8th. It was about inventories 800. Yeah, so debit side, credit side, we're done with this. Next case. Business buys office furniture for 600. So office furniture, I think we also haven't had before. So we are here, they buy this. So yeah, this asset goes up. We make the note on the left side, on the debit side. And the date was January 11. How is it bought? It's cash. we need to have it here on the credit side as well. $600, right? So this is how this works. Yeah, let's maybe do one more, and I think then we can go on, because otherwise it might get a little boring. Business sells inventory costing 600 for 900 on credit. Actually, we basically did this case before, so this was this transaction with 2 times 2 notes we have to make. So where should I start? Cost of sales, I think we had them here. And what are the cost of sales? So it's inventories, right? Cost of sales 600, I heard. Okay, and then we need, of course, the note here. Cost of sales 600, right? Then, so we have the cost side, now the revenue side. So here, let's maybe start with the so they sell this on credit. That means we have this trade receivables, right? That's exactly the same as we had before. Oops. Sales revenue, how much was it? 900? And here we are. Oops, sorry. Trades receivable 900. Okay, so you see, it's basically the same we did before, but there we didn't use this T account for. But in the end, we always thought, well, what elements of the income statement or elements of the balance sheet are affected, and then we basically took it directly in there, and here we take this detour over these T accounts. And of course it should be obvious why this makes sense to do, because I mean, if you have a lot of transaction, and that's a normal thing for firms, things become super messy if you directly want to adjust the financial statements with each and every transaction. So that's a way how to bundle these transactions, and then in the very end use everything, or use the, let's say the residual of these single accounts to set up the financial statements. And we'll look how this is done in a minute. But in general, as you see, these are all things you already dealt with. It's just another way of writing these things down. Yeah? So, as I said, you should be able to do every exercise applying this technique already. Okay. Then, let's go on with the slides. So, what comes out if you do this properly is basically something like this. Yeah? So here everything is in. That means you can double check whether you understood correctly when you repeat this at home. This is actually the solution with all the transactions in. Yeah? And having this, having dealt with the transaction, then allows to go the next step. So what needs to be done next is balancing or summarizing these accounts. Because what will happen is that, well, the sum on the debit side and the sum of the credit side will usually not be the same, and the question is how to deal with this, how to go on. And first thing you do is you add up the column with the largest amount and put this total on both sides of the account. reads a little cryptic, but if you look at this example, you see what's meant. So you basically make the sum. Yeah, no, wait, let me show you maybe also in Excel. Okay, so what I did here is I calculated this sum here, and if I would do the sum here, I would end up with 3,000. So I have this cash inflow written down on the debit side, amounting to 7,800, and I have cash outflow, I've written down on the credit side, but this amounts only to 3,000. And what we just had on this slide, sum up and write the larger number on both sides. It's actually, well, I make the sum and I see this one is the larger number, so I put here on the right side the same number. That's basically this first step, what's meant in this first step. Yeah, let me go back. So that's what we have here, adding up the column with the largest amount and putting this total on both sides of the account. Yeah? First step. Then, second step, recording the figure that is missing to get to the respective total in the column with the lower amount. Yeah? So again, sounds a little cryptic, but in the end, what's needed is you need to come up with a number here, so the sum here on the credit side is the same as this higher sum on the debit side. So the difference between this 7,800 on the left side and the 3,000 we initially had cash outflows on the credit side is 4,800. And this is what you calculate and what you write down there. Yeah? So this is actually the difference between this higher sum and this lower sum. Yeah? So this is the second step here on the slides. And then the third step is we have to write this number on the respective other side. So in this case, on the credit side, below this total. So this is called balance brought down, 4,800. And you should already realize this is actually what will show up later in the statement of financial position, because it's the difference between cash inflows and cash outflows. So it's basically what's there in cash after this month and all these transactions, right? So that's the idea, how this works and how you come to this respective figures in the financial statements. So this is an example for a balance sheet item. Yeah. Then having this, let's stick here. This is another example. So the whole bunch all in one. The inventories account. So what happened there? We also had more inventory inflow than outflow. These 2,200 was larger than, well, this outflow of inventories worth 800. So you see the difference was 1,400 to balance both sides of this account, and the balance sheet will end up with 1,400. Yeah, maybe an understanding question about your understanding. What would happen if the balance of inventories were on the credit side? How to deal with that? What would happen if the balance, the 1,400, were not on the left side, not on the debit side, but on the right side, on the credit side? What would that mean? But it's not cash, it's inventories. is this possible to be in debt of inventories? No, it's not possible. Then you made something wrong. So this would be a sign that something is off. So it could be with cash. We talked about this bank overdraft, right? There it might happen, but with inventories it cannot happen. I mean, it could happen if you overestimate the cost of sales, right? But you see here, well, a few conventions we previously talked about kick in. So you cannot invent numbers for the cost of sales, right? So here you can only, the upper limit of cost of sales is what you've paid, because otherwise it might really end up with a negative inventory, and this is not possible. Yeah? So be careful here that, well, this would not make sense if this ends up on the credit side. Then you should recalculate and check whether you made a mistake or not. Yeah? So you see this also, this methodology also allows you to do some kind of logical checks, right? Okay. Then, balancing or summarizing sales revenue. So here everything is relatively easy because revenues we only have on the credit side, but we apply the same technique, yeah, and we later have this balance on the credit side, and yeah, you should directly realize that this is actually, well, the revenue you will have in the first line of the income statement. I mean, there's a little step in between before you write it down, technically, but this is actually the revenue number ending up on the income statement. And, well, this can be done for all accounts. So here again, the example, I know it's relatively small, but as I said, everybody should be able to do this. It's really just applying this technique. I see that we actually have a break. Yeah, no, I think it's a good time to have a short break and then we'll finish this up.